Lead Analyst here, and welcome to Iron Financial. We are absolutely obsessed with helping you forge a stronger, much more resilient portfolio while cutting straight through all the market weakness and noise. Today, we are looking at an absolute earthquake right in the middle of the retail sector. Honestly, if you look at the retail graveyard over the past few quarters, it has been absolutely brutal out there. We're seeing fast casual chains missing their estimates left and right, and the broader narrative on Wall Street is that consumer discretionary spending is just completely pulling back. People are tightening their belts. But against that highly pessimistic backdrop, we have a company that just delivered a massive fiscal second quarter earnings blowout, which actually sent its stock surging roughly 5% in after-hours trading. We are putting SBUX under the microscope today. We're going to inspect the structural numbers, the revenue, the debt, the margins, and figure out if this turnaround has real concrete durability. Market skeptic, what's your read? Off the top. Well, market skeptics stepping in, and look, a 5% after-hours pop is flashy, for sure, but we've all seen this exact movie before in our current economic cycle. A company beats some heavily beaten down expectations, the market cheers for a day, and then 3 months later, the foundation completely cracks. My job today is to figure out if this is actually a durable asset you want to forge into your portfolio, or if it's just another value trap wrapped in a green apron.
Okay, let's dive into this. SBUX Corporation. Now, for the last couple of years, this iconic global brand honestly looked like a distressed property. It was struggling. But in Q2 of 2026, CEO Brian Niccol delivered what truly looks like a monumental structural repair. We saw a powerful earnings beat across the board, signaling that his whole turnaround strategy is taking hold far faster than anyone on Wall Street anticipated. But hold on, before we start pouring the concrete on this massive bull pace, we need to ask some really hard questions. Let's remember the context leading up to this earnings call. The stock actually traded down to about $97 during the day, right before the earnings hit the wire. The prevailing sentiment across institutional desks was pure, unadulterated pessimism. I mean, investors were bracing for an absolute disaster. So yes, the expectations were heavily muted. Simply surprising a pessimistic market for one single quarter does not automatically establish a long-term load-bearing trend.
Which brings us right to the core question of this entire explainer. Don't sell me the dream just yet. I want to know if this Q2 blowout is just hype or if it is a truly solid foundation. Is CEO Brian Niccol's plan actually demonstrating real structural integrity? Or is this whole thing just a temporary sugar high fueled by a few limited-time menu offers and incredibly easy year-over-year comparisons? You know, the kind of comparisons where anywhere looks up because you are already at rock bottom? That is exactly what we are going to drill down into today. We are going to look at the top line, we're inspecting the margins, we're picking apart the strategy, and finally, we'll deliver the verdict. It is time to see what this corporate structure is really made of. Section 1. The drill down. Top line. Let's inspect the raw numbers. Listen, when you are assessing any corporate turnaround, you absolutely do not start with the fresh paint job. You start with the heavy lifting. You have to look at the raw revenue and the earnings per share to see if the business is actually growing organically or if it's just bleeding cash behind the scenes. Wall Street analysts had penciled in an earnings per share of 42 cents on $9.09 billion in total revenue. That was the benchmark. What did SBUX actually deliver? A blowout non-GAAP EPS of 50 cents on $9.53 billion in revenue. Think about that for a second. That is an 8-cent beat on the bottom line and a massive, near $500 million top-line beat. That $9.53 billion represents a solid 9% year-over-year increase. And the most impressive part? It wasn't just a fluke in one specific region. We're seeing a broad-based, highly structural recovery in customer traffic across key U.S. suburban drive-thrus, major urban centers, and critical emerging markets alike. Okay, I will definitely admit crushing the street's consensus by nearly $500 million in revenue is extremely notable. But context is literally everything in this game. Beating artificially low estimates is one thing, showing actual fundamental growth from a point of extreme weakness is another. I want to know what this looks like compared to the actual dark days. Oh, you want the dark days? Let's take a look back. In Q2 of 2025, SBUX was fundamentally bleeding. Global comparable store sales were negative 1%. U.S. transactions were down 4%. Earnings per share was down a staggering 38% to just 41 cents. Wait, a 38% EPS drop in a single quarter? That wasn't just a mild earnings miss. They were in a complete financial freefall at that point. Exactly. It was a massive structural hazard. But fast forward to Q2 2026, and you see what I call a textbook financial recovery. We have a 32% jump in GAAP EPS, going from 34 cents up to 45 cents. The non-GAAP EPS jumped 22% to 50 cents. And here is the real load-bearing metric that proves the foundation is holding. Global comparable store sales increased by 6.2%. That demonstrates the foundation has successfully caught the falling knife and is now supporting real upward momentum. A 6.2% comp growth is genuinely impressive, I'll give you that. But where exactly is this growth coming from? Are they just jacking up prices on loyal customers to mask the weakness? Or are actual human beings coming back through the doors? Section 2. The drill down, the margins. Let's see if this growth is actually profitable. Before we fully break down those domestic transactions, we really need to inspect the margins. Top-line revenue means absolutely nothing to your portfolio if the underlying framework of the business is bleeding cash to generate it. We need to see if the overall cost structure is sound, 19.4%. Let that number sink in. That represents the international segment's operating margin for Q2 2026. That is a massive explosion in profitability from just 11.6% the year prior. Wait a minute. How do you nearly double your operating margin in a single year? That definitely doesn't happen just by selling a few more iced lattes. Spot on. It happened through some highly strategic, aggressive restructuring. They essentially fortified their overseas base by completing a joint venture in China with BUX Capital. By deliberately reclassifying their China retail assets as held for sale, they are deconsolidating those extremely heavy store-level operating expenses completely off the income statement. Essentially, they are shifting toward a franchise and licensing model in a high-scrutiny, economically volatile region. This surgically strips out heavy capital expenditure and day-to-day operating costs, which immediately and structurally inflates the margin percentage on the remaining corporate revenue. They cut away the dead weight to dramatically reinforce the core international structure. Okay, the international financial engineering is neat, and it certainly cleans up the balance sheet. But let's be real, Starbucks lives and dies by its domestic foundation. I demand a look at North America. If the U.S. consumer is actively rejecting them, the whole corporate structure collapses, no matter what they do in China.
Fair point. And here is your concrete answer. North America comparable store sales surged an incredible 7.1%. And to directly answer your earlier question about where this growth is coming from, it is not just artificial price hikes. It breaks down to a massive 4.3% rise in actual physical transactions, combined with a 2.7% lift in the average ticket size.
Hold on, a higher rise in actual transactions than in ticket size? That's a huge psychological shift for the consumer right there.
Exactly. It means people are actively coming in more frequently for their daily drip coffee or their morning iced beverage rather than just showing up once a week to splurge on some highly customized, expensive frappuccino. A daily habit forms a much stronger base than the occasional splurge. People are returning to the stores, and they're establishing a reliable, recurring routine again.
This right here is the absolute definition of a reinforced base.
I have to admit, seeing a 4.3% rise in foot traffic after they were down 4% a year ago is a serious reversal. But how did management actually pull off this structural repair? What did they physically change inside these stores to make this happen?
Which brings us perfectly to Section 3, the drill down, the strategy. Let's look at the actual blueprint.
The Back to Starbucks plan rests on a few absolutely vital pillars that represent the real heavy lifting behind this turnaround. First, green apron labor investments. Management finally realized you simply cannot provide a premium coffeehouse experience if your stores are chronically understaffed, stressed, and chaotic. Second, rigorous menu simplification. They ripped out the complex, slow-moving items to completely clear the operational pipeline for speed. Third, and this is absolutely crucial to the balance sheet, they paused major capital expenditures on overly complex equipment. They completely stopped rolling out the capital-intensive Siren Cold and food systems broadly across the network. Wait, what exactly was the issue with the Siren system? I thought investing in automation was supposed to be the ultimate fix for speed and efficiency. In theory, on a spreadsheet, yes. But the Siren system involves massive, incredibly complex refrigeration and highly customized ice dispensing units. Pouring capital into these massive machines required literally ripping up store floors, completely redesigning the layouts, and taking profitable locations offline. And ultimately, it wasn't actually speeding things up because they completely ignored the human bottleneck. The single stressed-out barista trying to operate an increasingly complex piece of machinery while fielding an absolutely endless queue of mobile orders. So management wisely stopped pouring money into machinery and shifted all that focus back to craft, human connection, and raw speed to win the critical morning peak. So basically, they stopped buying expensive, high-tech machines and just started paying for significantly more labor hours. Exactly. As CEO Brian Niccol put it so clearly, our success starts and ends with our customers and our green apron partners. But hold on, the lead analyst in you should be absolutely screaming right now. You cannot just blindly throw human bodies at a margin problem. Adding millions in labor hours means dramatically higher operating expenses. In fact, if we look back at the 2025 data, we saw severe margin compression in North America specifically because of these exact labor investments. Management literally cited a 450 basis point margin contraction previously due to deleverage and skyrocketing labor costs. You simply cannot expect institutional investors to cheer while domestic margins get actively squeezed just to cover basic operational flaws. I completely hear you, but sometimes you literally have to pour a much deeper, more expensive foundation before you can safely build the skyscraper. The North American operating margin did admittedly see some slight contraction due to these necessary investments and lingering inflationary pressures, but I will defend it all day long as an absolutely necessary reinforcement of the company's core operational pillars. The strategy was brutally clear from day one. Top-line improvement and transaction volume would come first, with earnings growth to follow. And the Q2 transaction numbers emphatically prove the strategy is successfully capturing that latent consumer demand.
Furthermore, management isn't just spending blindly to fix the problem. They are keeping the house in order. Their 2026 proxy filing reveals they are actively and aggressively managing the broader cost structure. Executive pay is now hardwired into extracting $800 million in operating expense savings. Wait, cutting $800 million in just 2 short years? That is a massive, highly aggressive target. Where exactly is that kind of fat going to come from if they are simultaneously pouring cash into store-level labor? They are hunting for major efficiencies everywhere else. We're talking massive supply chain optimization, ruthlessly reducing waste, and heavily leaning out the corporate overhead. The CEO and executive vice presidents literally have $6 million performance-based restricted stock unit targets hanging over their heads. And here is the absolute kicker. None of these PRSUs will vest, meaning they get nothing unless they hit that specific, non-negotiable threshold goal of $800 million in cumulative OPEX savings across fiscal years 2026 and 2027. Management has ultimate skin in the game here. They have to fund their store-level labor investments by violently cutting the fat at the corporate level, or they simply do not get paid. So the crucial takeaway for your portfolio is that we have a business with accelerating top-line growth, highly disciplined international restructuring, and a management team that is financially incentivized to ruthlessly cut cost.
Section 4. The verdict. Opportunity or trap? Let's bring it all together. Let me go first here and point out the real cracks in the armor, because there are definitely some serious bearish red flags here that smart investors absolutely cannot ignore. First up, insider selling. The SEC filings clearly show Executive Vice President Sarah Kelly sold nearly $243,000 worth of stock in early March, and CEO Brady Brewer sold over $58,000 worth in April. Now, while some of this is undoubtedly under prearranged 10b5-1 trading plans, seen top insiders trim their positions during a highly fragile turnaround phase always makes me nervous. Second, persistent margin pressures from that domestic turnaround spending. If inflation spikes again, that massive heavy labor cost will be an incredible burden on the bottom line. And third, severe employee friction. Starbucks is in the middle of moving its massive corporate headquarters from Seattle all the way to Nashville. You are looking at a monumental loss of institutional knowledge, massive severance packages for staff who flat out refuse to relocate, and major hiring delays trying to staff up in a totally new city. You cannot just uproot your entire corporate base without triggering severe short-term operational disruptions. Those are totally fair points, but let me quickly counter with the bullish, load-bearing facts that support this structure. First, the street is actively upgrading this stock. The consensus target price has steadily moved up to $104.75. Second, you are literally getting paid to wait while they rebuild. They just disclosed a quarterly dividend representing a very solid 2.5% yield. That's a highly reliable, concrete cash flow stream for your portfolio. And finally, just look at their forward guidance. They are confidently projecting a solid $2.25 to $2.45 non-GAAP EPS for fiscal 2026, alongside 5% or greater comparable store sales growth. Crucially, they expect to open over 600 net new coffeehouses globally, focusing heavily on highly profitable, purpose-built drive-thrus in the US and low-capex, high-margin licensed stores internationally. The structure isn't just sound, it is actively, profitably expanding. So, looking at the entire corporate blueprint, the big question remains, is it time to buy the turnaround right now or safely wait for a pullback? The options market implies some elevated volatility ahead, with traders actively expecting a sizable post-earnings move of around 6 to 7%. Look, as your lead analyst, my ultimate verdict is this. Starbucks has unequivocally proved that the Back to Starbucks plan has real structural integrity, beating EPS by 8 cents, driving a massive, habit-forming turnaround in North American transactions, and locking executive pay directly to an $800 million OPEX cut, shows a heavily reinforced foundation. Yes, there's always going to be noise, but the heavy lifting is done. And as the market skeptic, I will officially concede that a 4.3% transaction growth driven by actual consumer habit in the US is very, very hard to argue with. The China joint venture is undeniably a brilliant risk mitigation move. But you better believe I will be watching those domestic labor costs and the operational fallout from the Nashville relocation like an absolute hawk going into the next quarter. And that's exactly what we do here at Iron Financial. So we leave you with this final crucial thought for your own portfolio construction. When an iconic global brand successfully fixes its foundation, simplifies its business, and the crowds begin to consistently return, do you want to be the one standing safely on the sidelines or the one actively collecting the dividends? Let us know what you think. Keep forging those strong portfolios.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.